In the last few months, there's been a rather unusual thing going on with a few holdings I have in my portfolio, which is that some of them have become the target of short reports. And I don't recall there ever being a time where several of my holdings have seen so many reports being published in such a small amount of time. If you're not familiar, a short report is a publication that's made by a company or an individual that states they're opening a short position on a stock, which means to bet against it, and they usually provide detailed research that attempts to prove that a company is about to suffer or even collapse. A lot of the larger companies like Tesla, Roku, and Salesforce are targeted by these kinds of reports all the time. But the majority of what I focus on and invest in are not mainstream companies. Stocks like 6th Street Specialty Lending, STAG Industrial, and Main Street Capital aren't covered as much as Airbnb, Exxon, and Alphabet. So this has been something that I'm really not used to seeing with a lot of stocks in my own portfolio. You might recall that back in March, Arbor Realty was attacked by a company called Ninji Research who claimed that they were hiding bad investments in order to manipulate their stock share price, among other accusations. After I read the report, I came to the conclusion that the people who wrote it had no idea what they were talking about. A lot of their claims were backed up with little to no evidence, and it was full of grammatical errors. And last week, Arbor Realty released their latest earnings in which they crushed expectations and they grew their dividend by 8%. Another company that I have a small position in that's seen a number of short reports is Medical Properties Trust, ticker MPW. I've been covering this stock for a while, and it's pretty well known that they've been struggling with one of their largest property tenants, which is Steward Health. Despite a lot of short attacks and MPW's share price falling hard, there still hasn't been a dividend cut. Although Medical Properties isn't out of the woods yet, as they're still working on a resolution to their problems. Just recently, another one of my holdings just became the victim of a short report by a company called The Bear Cave. This website releases short reports on a pretty regular basis on all different types of companies. Last week, though, they did release a hit piece on Triple Point Venture Growth, ticker TPVG, which is a company that I own. They're a business development company specializing in investments in venture capital-backed companies at their growth stage. They also provide debt financing to venture growth space companies, which includes growth capital loans, secured and customized loans, equipment financing, revolving loans, and direct equity investments. So they're a BDC that typically invests in companies that are still in their growth stage and that are already backed by venture capital firms. These are companies that are already operational and they're seeking more funding to expand even further. On May 2nd, a report was published on the Bear Cave that claims that TriplePoint is a company that's suffering from poor management and a collapsing investment portfolio. Starting at the top of this report, it talks about how a couple companies that TriplePoint has invested in have gone bankrupt. For starters, it brings up Medley Health, which was an online pharmacy that declared bankruptcy in December of 2022. TriplePoint had lent $34 million to this startup, but it turns out that former employees, as well as some of the founders, were secretly engaging in improper activities and reporting financial irregularities according to TriplePoint. Then in April, another company TriplePoint had lent $20 million to had also filed for bankruptcy. The Pill Club, which was a birth control and telehealth company, filed for Chapter 11 bankruptcy after California's authorities accused the startup of fraudulently billing the state's Medicaid program for contraceptives customers said they didn't order. These two cases obviously aren't good for TriplePoint, but in highlighting these companies, I think there are two important factors that need to be taken into consideration here. First, both of these companies suffered from scandals. They didn't go bankrupt purely because of the products or the services that they were providing. The scandals they suffered played a role in them going bankrupt, and unfortunately, it can be really hard, if not sometimes impossible, to see signs of a scandal. High-profile companies like Enron and Theranos fooled a lot of people for years, and they received billions of dollars from investors before the tide went out and they were exposed. The second point I want to make is that TriplePoint loans are senior secured loans. The money that this company lends out receives the highest priority for repayment. You can see this pyramid that shows that senior secured debt holders get the first claim of remaining assets if the company has to liquidate. Whenever a company goes bankrupt, its assets are sold and the money is used to pay back its debtors. If there isn't enough money to pay back all debtors, then what is recovered will completely go to senior debt holders first. So for example, if a company takes out $100 million in senior secured debt and various other types of debt, and they need to liquidate their assets and only get $75 million from the proceeds, then all $75 million will go to senior secured holders, and then unsecured, preferred equity, and common equity holders will get nothing at all. So even though TriplePoint might write down $34 million from Medley and $20 million from the Pill Club, they will get a portion of their money back. We don't know how much yet, but according to Moody's, the average historical recovery rate for senior secured debt is about 77% according to this article. So even though a company might go bankrupt, it does not mean that the BDC that lend the money is going to lose everything. But according to this report, it claims that they found 10 additional companies that TriplePoint has provided debt for that are in substantial distress according to this report. And these companies have received $170 million in total from TriplePoint. They're predicting that in the quarters ahead, a lot of these companies are going to be unable to pay TriplePoint the money that they're owed, which is going to lead to a lot of chaos for this company. And so although I didn't want to, I went ahead and I paid $65 to read the full report so you don't have to. To be fair, some of their criticisms are legitimate, but in my opinion, a lot of them are not. For some of these 10 companies, the Bear Cave referred to recent articles that were published about them that talk about their struggles. But after reading them, I didn't really see anything that would indicate that any one of these companies is definitely going to go bankrupt. One company was highlighted as being in serious trouble because they just laid off 15% of their staff and were spending between $10 million and $25 million a month last year. Now that sounds like an insane amount of money, but the author of the report admitted that already this year this company has received about $140 million additional dollars in funding. If they're cutting costs and they've already received $140 million in additional funding, that doesn't sound like a ticking time bomb that's about to go off. You've already received enough cash to make it through the end of the year and even further. For two of the companies that the author claims are in serious distress, the author only referred to Glassdoor reviews he read. Glassdoor is a website where anyone can create an account, claim that they worked for a company, and leave a review. Anything that anyone says is not checked or verified by anyone. You can go onto their website, leave a review for a company you don't like, and make as many false accusations as you want to. Nobody takes this kind of research seriously. There are some other companies mentioned in this report that are facing difficulties, but they also vary a lot in terms of how much TriplePoint has lent them. One of the report's harshest criticisms is for a company that only received $2.25 million. Considering TriplePoint's debt portfolio totals over $890 million, I'm not that concerned about this company suffering losses. $2.25 million is less than 1% of their overall portfolio. But like I said, there is some stuff in this report that does raise some red flags, but you can't say anything in this report proves that any one of these companies is about to go bust. In my opinion, the most important thing brought up in this whole report isn't even behind the paywall, and it's actually in the second paragraph. It says, for a sense of TriplePoint's troubles, investors need to look no further than its publicly disclosed net asset value, which has declined from $14.01 per share in fourth quarter 2021 to $13.84 in the first quarter 2022, $13.01 in Q2, $12.69 in Q3, and $11.88 in the fourth quarter of 2022. This is true, and it actually is a concern I have for this company. TriplePoint's NAV has been falling at a much faster rate than any other BDC that I'm currently invested in. A falling NAV indicates that a BDC is suffering losses in their portfolio, and a BDC usually trades in share price around their NAV. If this keeps happening, then a dividend cut becomes more likely as time goes on. Fortunately, because TriplePoint invests in floating rate loans, they have been collecting more interest income on the loans that they do have thanks to rising interest rates. The fact is, TriplePoint is a much riskier BDC in nature because they target much younger companies that are much more likely to fail. Other BDCs like Ares Capital, Main Street Capital, and Owl Rock Capital lend money to older companies, and these typically see much fewer losses. Two other BDCs that invest in startups would include Trinity Capital and Hercules Capital. Out of the three, Hercules Capital would have to be my favorite because they have a much longer track record and a much larger portfolio. After reading this report, I couldn't decide what I wanted to do with this stock. It makes up a pretty small percentage of my overall portfolio, so I spent a long deal of time thinking about the pros and cons of this. In a recession, the companies that TPVG invests in are going to be much riskier, and they will probably see more companies going bankrupt. Even if that is the case, we don't know how severe these losses are actually going to impact the dividend, though. It's also a very high-yielding stock that just recently grew its dividend again. If you're a risk-averse investor, I'd honestly suggest staying away from this stock because it is a riskier BDC. For me, I'm planning on just holding on to the shares that I have for right now. I probably won't add any more shares, but I'll just be hanging on to what I have, and I'll keep monitoring this situation. But with that being said, thank you all so much for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.